Mortgage industry news you can use. Hi, I'm Chip Cummings, and welcome to the Mortgage Minute, a brief look at this week's news and headlines to help keep you on top of the market. Brought to you by Mortgage Power Network. Mortgage Power Network, helping you power up your business. Well, it's springtime. I hope everyone had a safe and happy holiday, but I gotta tell you, even though I'm dressing the part, I'm not feeling any better. We've got 20 degrees outside and 6 inches of snow. I'm ready to get out of here, get somewhere warm. Before we do get started today, I want to say hello to one of our brand new corporate partners. Our corporate partner this week is High Tech Lending. Great big hello to everybody at High Tech. Well, it was certainly a big week in the world of mortgage news. So let's get right into it. The big news this week was the Federal Reserve cutting interest rates. They cut an emergency 0.25 basis points and then came back to slice off another 0.75%, leaving the Fed funds rate at 2.25%, the lowest it's been in quite some time. That, coupled with the Bear Stearns collapse and the Fed coming in to help, surely didn't help the market out much. Now, what does this mean to you? Well, first of all, with Bear Stearns gone out of the picture, it means less likely places to place subprime loans. Many of those programs were securitized by investment banking firms such as Bear Stearns. Now that they're gone, investors have less of a place to put that money, so fewer choices for your borrowers. But what did the market do? How did it respond? Well, applications are down. The number of applications taken this week fell 2.9% as compared to a week ago, according to Freddie Mac. And more importantly, that's despite the fact that the 30-year fixed rate right now is standing at 5.87%. That's down from 6.13% just a week ago. Well, with all the bad news in the marketplace, it just keeps piling on. This week, new report shows that mortgage insurance availability has now been severely curtailed. In fact, 25% of the nation's zip codes can't even get mortgage insurance policies. This is going to be really tough going into the spring market. Some mortgage insurance firms have completely eliminated mortgage insurance in areas like California, Nevada, Arizona, Michigan, Ohio, some of the hardest hit areas. And just as we're heading into the time when new first-time homebuyers are entering the market, we find that 40% of borrowers who would have qualified a year ago no longer can qualify. But it's having a bigger impact on the marketplace. As a matter of fact, the report also shows that of new mortgages that were originated in the fourth quarter, there was a 38% drop in that value of those mortgages to $450 billion. More importantly, the subprime portion of that pool registered a 90% decline in value. That tells you there is no appetite for those mortgages. No appetite means no loans. No loans gives borrowers fewer choices. So what are we going to do? Well, the first thing that we need to do is get rid of the players that don't belong here in our industry. They make a bad name for all of us. I'm talking about mortgage fraud. The FBI has started to take notice. As a matter of fact, they've opened up investigations on 17 of the largest mortgage banking firms in the country to try and uncover what led to the subprime collapse. They've got over 400 agents looking into mortgage fraud, securities fraud, originations, anything that they can try and peg. Now, I think this is a good thing, and I've always told my employees that one deal doesn't make a career, and it's just not worth it. Unless you can make enough money to buy an island and go live on it for the rest of your life, why jeopardize your entire career? Also in the news, the ex-COO of Countrywide, a man by the name of Sanford Curlin, has decided to start a brand new mortgage company. Him and 9 other former executives of Countrywide have started a company called Private National Mortgage Acceptance Corp., or PennyMac for short. Sounds catchy, huh? Well, PennyMac's mission, according to their website, is investing and servicing in residential mortgage assets for private investors. AKA hard money, guys. They're trying to pick up where the market is left off. Maybe they know something that we don't. Based where else? In Calabasas, California, home of Countrywide. Now, on a related note, Countrywide in the last 12 months has lost, get this, $703.5 million. First loss they've ever had in 30 years. Maybe Sanford and his buddies know something that we don't. Timing is everything, isn't it? Also this week in the news is FHA. No, it's not our FHA Modernization Act that we are still waiting for Congress to get their act together and pass, but rather Secretary Alphonso Jackson, who made a new proposal to the White House to try and help solve the foreclosure crisis. Now get this. FHA, of course, insures 100% of the loan value. What Secretary Jackson has proposed is to insure 80 to 85% of that value to help homeowners get an FHA-insured loan without exposing the government to risk. Now, in the proposal that he made on Friday, he said he understood how some homeowners felt. And I quote, "They may not have been aware of all the terms because I've had 8 houses and didn't read all that mess." Come on, Secretary Jackson, you're the head of our industry. You're the one that's putting forth a RESPA reform proposal, remember, with a 4-page good faith estimate and new disclosures and everything else. If you're not reading the documents, who is? Well, to top it all off, he says that the proposal will give ourselves leeway if the values fall a little bit more. Who's left to pick up the value? Well, the lenders, of course. They'll pick up the losses of the difference in the 100%. Now, in other news, we also know that foreclosures are big business, and big business can mean something for you and your bottom line. Foreclosure tours have started to take off around the country. As a matter of fact, tours are really big now in places like Phoenix, Arizona, Orlando, Michigan, Las Vegas, the Bay Area out in California. You need to know how to set up a foreclosure tour. This is a great way to partner with a real estate agent. We're going to be having a conference call coming up in the near future with a real estate agent who specializes in setting up these foreclosure tours. In order to make sure you get an invite, go right now to www.ecoachingclub.com and make sure your name is on the list. We'll let you know when the conference call takes place, but this is a great way for you to start getting first-time home buyers into these foreclosure properties. And now for our weird news item of the week. This one comes to us from Staten Island, New York, right in the heart of New York City, where I guess you could call it a pissing match between a builder and the city is taking place. You see, there's a builder by the name of John Grossi who planned to tear down a 19th century home and in its place put townhouses. Now, when he was denied the permits, in order to spite the government, he went and spray painted this beautiful 19th century home. In retaliation, the government turned around and dictated that the home was now a landmark, protecting it so that he couldn't tear it down. Well, he wasn't done. Undeterred, Mr. Grossi staged a mock crucifixion on the lawn. And the city was so impressed that they had him committed to a psych ward for several days. Well, again, not diminished, Mr. Grossi felt that his rights were violated. He filed a lawsuit for $10 million. $10 million lawsuit. And the claim? Violation of his free speech and also, and I quote, the loss of procreation of the Grossi's first child because he wasn't available to be with his wife. What? He's suing the city for $10 million because he couldn't get sex. Now, only in New York, right? It would have been a lot cheaper if Governor Spitzer had just given him his black book. Well, whatever the case, this suit is not going to be over soon, and we'll fill you in on how it ends up. Oh, by the way, that beautiful 19th century house is now in shambles. It's in disarray, and of course, it's in foreclosure. Only in New York, right? Well, on that note, that's all the time we have. I'm Chip Cummings. Thank you for joining me on the Mortgage Minute, brought to you by Mortgage Power Network. Make sure you sign up for this week's session on the loony RESPA reform proposal and how it can kill your business. Sign up for that session and many others for free at ecoachingclub.com. In the meantime, think warm, think spring. At least I'm going to try to. And until next week, I'm out of here.